Well, I can't believe that I'm doing this again. For the second time today, I'm recording the video in my car, this time sitting stationary. I got a video here that I'll try and keep this as unedited as possible, besides showing you what's on my screen as I'm currently screen recording. And we'll hope that the audio is something manageable. I'll clean it up as best I can. I want to talk about the PPI that comes out tomorrow at 8:30 a.m. Eastern Time. The market expectations that are on there, the historical data that I have, my own take on things, what I think, what I expect to see, and also what I think the market will do in light of those expectations that currently exist for the final demand for PPI and also core PPI that is less food, energy, and trade. So I'll talk about those things in this video. Thanks for tuning in. I'm Dr. Stock, Doctor of Education. Let's get right to the information. All right, so the data that we're looking at first is the final demand data. And I cranked out from throughout its history from November 2009 through November 2022. You can see the minimum value that we have is negative 1.3%, maxed out at 1.7%. And these are month-over-month values. That's what the mom analysis is. We're not analyzing anybody's mom, so I hope you don't think that. These are month-over-month values for final demand for the PPI for its history. The range then is 3%. The average month-over-month value that we have is 2.3%, median of 2%, and also standard deviation of 0.4%, which doesn't really mean a whole lot until you look over here at the one that says since, and I'll put them both on screen so you can see both of them. Not sure why this is jumping so much, but it is. So when we look at it from March 2020, so the start of the pandemic through now, you can see that we still have the same max and min values. So those values came in again during the pandemic, if not for the first time. Although it looks from the frequency that negative 1.3 came in during the pandemic and not before during its brief history for over the past 13 years or so. Maxed out at 1.7, again, happened during the pandemic. I think it only happened once. We'll see that when we look at the frequencies. The range still the same. The average shifted up. The average almost doubled in month over month, up to about 5%. And if we show another decimal place, there we go, 5.4%. So that 5%, 0.5% was rounded down. The median 0.6% and standard deviation of 0.6. And when we look at the standard deviations, when we compare them, standard deviation is a measure of spread or how much variation you have in your data. And so a smaller standard deviation, your data are more closely clustered together, and a larger standard deviation, your data are more spread apart. So since the pandemic, our data have become more spread apart, more volatile over time, and well, we know it's been volatile, and this is just a little bit of hard numbers from history that show that. So we can see a little bit more of that with this color coding that I have in the next table, where it shows all the possible values that we've had in the month over month, the distribution throughout the entire history. That's the one here on the left. The one on the right is since the pandemic. And when I zoom in at the blue bar, you can see this where we would find that the mean is about 0.2% for the history of the PPI that's been tracked from 2009 to present. And you can see how it's been shifted down all the way down to 0.5% since the pandemic happened. As a matter of fact, let me look at that. Okay, so yeah, it did round down to 0.5. So these are to the closest tenth of a percent when we look at these. So that shift down that we have shows you that PPI has been running hotter, that inflation has been running hotter, that the producer price index has been up month over month since the pandemic. And also, let me zoom out a little bit more so you can see the colors. I mentioned about how much more spread out it's been since the pandemic. So when you look at the yellow areas, those are within 2 standard deviations of the mean. So 95% of your data will be between the first yellow value and the last yellow value. In the orange or the darker area, for those of you who are color challenged or color blind, I don't know what the current term is right now, you can see that those are also went from narrower to wider, and about 68% of your data is going to be found within those values. And then the blue, as I mentioned, is the mean itself, and you'll find that these values, as are presented here, are symmetric about the mean, even though it's not necessarily perfect. And I have that in graphical form over here, and you can see from the month over month all time, look how even of a pyramid that makes it. It's really more of a bell curve. I don't really have excellent drawing tools on here. If you guys want to watch me stumble through that, here, I'll do my best to draw a bell curve on this. You could do it, doctor. You could do it. There we go. Here's my blue dot. And then it comes up this way and then goes back down. And then all your values fit inside of there. And this is a fairly symmetric look, a fairly symmetric distribution. We don't have any long tails on the left or the right, and the peak is about in the middle. There might be a little bit of kurtosis here, which is just how pointy it is in the middle. So we might have a little bit higher of a concentration around the mean there. Look at the pandemic. The pandemic is a piano missing some keys, or maybe somebody missing some teeth. It's not as pretty of a graph. And if I were to draw from this distribution, we have a little bit more of a tail on this side. And yeah, we have that high frequency at 0.3, but really more of our data are clustered here. We don't have, and that's a horrible drawing, I apologize. We don't have the same sort of tail over here as we do on this side. This is a skewed left distribution showing that with our peak higher to the right, that our mean has also shifted to those higher values. So when we look at this, and this is final demand, when we look at this for PPI, and 7.4% is the month-over-month value that came in for the PPI. And again, I have these typical values highlighted within 2 standard deviations of the mean. And so when we see this blue area, that is the average month-over-month value that we have. And then for December, these values that are in red, these are the projections given the month-over-month that we get. So it's not impossible to get these values that are in white. It's just super unlikely that we do. Between the top and bottom white sections on this chart, that's only about 5% of the time that those values happen. So 2.5% below, or I should say, this is called below, even though it's on my chart above the yellow here, and about 2.5% of the time down here. The other 95% of the time, our PPI values month over month end up between negative 0.7% and 1.1%, with the mean of being about 2.2%, as I have highlighted here. Now, this negative 0.1 that I have highlighted for you guys, that is the market expectation right now, given a year-over-year value for December of 6.7%. So if we come in at that value, the market, I believe, already has it priced in. We're not going to see a whole lot happen if we hit that value. If we come in above that, we'll probably get a bit of a negative reaction. If we come slightly below that, we should get a very good green reaction in isolation, just from the PPI data. That would be upward pressure or downward pressure from the market. So upward pressure if we're coming above market expectation. Downward pressure on the markets if we come in above expectation, that inflation shows to be a little bit hotter than we expected. And downward pressure, oh my goodness, upward pressure on the markets if we're downward from this value. So if we come in below that value, we don't want it too much, but we want to keep it within these typical values that we have here. So what do I think is going to happen from there? Well, even though it's not as important as market expectation of negative 0.1% as the expectation in the mean of 0.2, I think that we fall within those values. Honestly, even, so 0% month over month, which would give us 6.8% year over year, possibly 0.1% month over month, which would be 6.9% year over year. And when we look over here at the St. Louis Fred, where these values came from, when we really inspect this most recent part of this, we sort of leveled out, but we still have that upward slant to this. Our concavity is down. So this would be sort of looking like it's still increasing, but slowing. So still a good sign, just not exactly where we'd want to be. So from this chart, it looks like we still have a little bit of upward climb to go. I don't know if December's been slow enough to pull it back down below November that we get that negative 0.1% month over month that we see. Like I said, even 0.1%, I think that those would be very, very usual values. When we look at the rates that we have here, you can see this jumps all over the place. And these are the month over month measures that we have. And we don't have this big volatile area that we had earlier in the year through 2021, through a lot of 2022, at least at the beginning, and then sort of settling from there. We had supply chains pretty much normalize. So that's a good thing. There was pricing power on behalf of a lot of the producers that I just don't think exists in the same way anymore, or at least is waning significantly, that I don't think that these prices are going to sustain. I think this is going to normalize quickly. December, I think, is going to keep us around that value. Like I said, November's reading of about 0.3% as according to what's here, but then coming in even below that for December, like I said, about even a 0.1. Market expectation is negative 0.1. We'll see what happens. Looking at the same information, however, this time for final demand, less food, energy, and trade services. I'll show you the data for that. So the month over month throughout the history, which starts November 2013, goes through November 2022, has a much narrower range at 1.8% instead of 3%. So this would be reducing some of that volatility in those areas. The average still rocking about 0.2%, median about 0.2%, standard deviation about 0.2%. So that's a smaller standard deviation, so less variation in our data than we had when food, trade, and energy were all included. And when we look since the pandemic, we still have that range of 1.8. The average shifts up to almost 0.4. So our average shifted up. So that's that higher typical inflation that we have. Median of 0.4, standard deviation of 0.3. So again, the variation increased just a little bit, not as much as it did last time. It does look like a narrower range here, the way that things kind of compress on us. I did line this up so that you could see the mean shifting down, so that the mean does sit higher when we look since the pandemic by about 0.2% month over month. The mean sits higher. So what does that mean for year over year? The market expectation for this is 0.1%, so just below the mean of 0.2. We could see that happen. Honestly, I think that's about right here. I'll highlight it for you, which would mean for core PPI measure year over year, 4.6%, 0.1% month over month. And for this one, December could have been sort of a cold month. Are producers losing some of that pricing power that we saw before? Is some of that demand drying up? Will it cause this to drop? I think that we have a really good chance of all those things happening. And when we look at the data on this one, so here, this is a much smoother curve, still the same, pretty much the same information, just less foods, energy, and trade services. And we still have that upward slant to this. So here, I'll zoom in so you can see it a little bit better. So we haven't really, kind of looking fairly linear here, that we still have that rate of increase and going even. That would be really surprising, again, if we beat expectations and we're near that value, but we beat it. That's upward pressure for the markets from this aspect, from the PPI. If we're above expectation, if it comes in hotter, that could be bad for markets. We see red in the markets, at least, if not red in the markets, we at least see downward pressure on the markets because of something that came in above expectations for PPI. And then when we look at the rate, the month over month rate that we have, we can see, again, that volatile period where there's a lot of disruptions throughout the economy, and there was a lot of pricing power, a lot of money going around before the Fed really started their tightening cycle. And since that time, it has come crushing back down and sort of normalized to look a lot more like it has throughout the history. So I better summarize this. I got to wrap it up. Producer price index report comes out tomorrow for core and for the for final demand for everything. And so negative 0.1 is the expectation for everything for final demand for PPI. And that, I believe, is, in my opinion, I think it's a little bit low. I think we come in about even, 0.0. The market knows more than I do. That's just my opinion. We'll see how it comes in according to the charts and according to history. You know that it does come in a little bit hotter than expected. As for the core PPI reading, that one I think is going to be about right. I think 0.1%, we come in just under average, and I think it's good news. And I don't think that we get a whole lot of movement out of this for the markets. So that's still good news for January. We start to look at retail data coming in. We still have all the reports, the earnings reports coming in, because it is earnings season, and the economic outlooks from those companies reporting. So be on the lookout for those things. Thank you guys for listening. I really appreciate it. I better wrap things up. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.